Hello, everyone, and welcome to Season 3, Episode 13 of Hedgeye's Unscripted Equity Curiosity. My name is Ami Joseph. I'm the Sector Head for Technology here at Hedgeye, and with me today is Felix Wang, the Sector Head for China here at Hedgeye. This podcast is meant to discuss equity ideas in all their shapes and forms and sizes, including macro or thematic or geopolitical or specific equities, long or short. And today, Felix and I are going to kick a few questions we have, update questions we have for each other that are lead out of each other's sectors and into our own sectors. So I have questions for Felix that are about his sector that can help me think about mine and vice versa. And we're going to turn the mic first over to Felix for his questions, and we'll go from there.
Great. Thanks, Ami. It's always wonderful to be on and to exchange ideas with you and also Andrew in our podcast. So I had a couple of questions for your space since you're the semiconductor guru. There's been a lot of headlines on these, export controls that's coming out of the US and China on pretty much a weekly basis now. The latest being some rare earth metals that could be potentially restricted. What are you hearing from maybe some of the semis that you cover? How are they responding to these back and forth, tit for tat, if you will, export controls regarding anything that could be related to the chips space? I mean, is there also a way around these restrictions? So that's kind of my first question.
Yeah, I think, first of all, I think that we've been talking about this economic war between these two countries, and it just seems to have no end in sight. Like, it just keeps rising and rising. And it's positive for some equities. It's negative for global growth of trade, but it's probably positive to some degree for example, for semiconductors overall, I would say, even though in this case, there's going to be a shortage or potentially tightness for some parts of semiconductor. Overall, the fact that Chinese components and Chinese semiconductor industry are being excluded from entering the global supply chain is positive for overall semiconductors. I mean, just for example, if you look at the fact that I think it was the back half of 2021, Apple was using XMT, which is a Chinese-based NAND manufacturer, and XMT is not a leading-edge manufacturer, and they don't have leading-edge cost structure, and they can't keep up yet with the leaders. But still, the fact that it was the first time ever that a Chinese supplier qualified to ship into Apple iPhone for NAND flash just shows that we were entering, or we're arriving at the beginning of a potentially very interesting period where Chinese supply could go mainstream. And I think that's been part of the short on Wolfspeed, for example, is the rise of Chinese suppliers. I think in the case of germanium and gallium, they're not mainstream flavors for semiconductor. They're important. Gallium arsenide and germanium are both flavors that appear a lot in radio frequency components. So it's not something that the world could just get by without. But it's not like a restriction on CMOS wafers or something like that. So it's one of the things that potentially the other countries who produce germanium, for example, Canada, Finland, Russia, the United States, I guess not Russia in this case, but Canada, Finland, the United States could increase their relative shipment in this area to offset that. But there's no doubt that China is doing this. And by the way, it's worse in gallium because the top producer is China, the second is Russia, the third is Ukraine. So you have to go look to Japan and Korea really for stable supply, and they are the minority suppliers. So it's not an easy setup, and it's going to create some tightness and pressure. And no doubt China is doing this specifically for that reason. But it just seems, I guess, the broader context is this sort of this conflict is just going to continue to escalate between these two.
Yeah, I'm kind of feeling the same way. At least, I mean, at first I thought it was mostly rhetoric, but now it seems like there's actual action being done here between the two parties. Obviously, how I feel about the issue is more regarding, collaboration is always better than competition. But as long as one party does something to the other party is probably going to try to fight back in some respect with these export controls. But that's really helpful on me.
Yeah, I mean, my main point is that even though like an announcement like this will potentially create revenue hurdles for a specific company or restrictions for a certain company that then have to be factored into estimates, so that's negative. The broader move is keeping China out of shipping semiconductors into the world is positive for oligopolistic pricing and oligopolistic Western competition model and mature period of growth where growth decelerates, but operating margins are healthy. And so it's probably good for multiples because people will extend the duration of this kind of earnings period and push out further the potential volatility that could come from China entering semiconductors whole hog with excess supply built from national concerns, meaning nationally financed with a better or lower ROI hurdle for those finances because they're government finances, just the same way that Taiwan entered the industry and Korea before that and Japan before that and the United States before that. So I think there's I think it's probably good for multiples, even if you have to sort of like start to remove some things from estimates along the way due to shipment limitations that are related to this trade war.
And so speaking of multiples, I guess this is a segue into my second question for you is, geez, like NASDAQ, tech, frenzy, automatically I think of what happened during the internet boom in the late 90s, driving up valuation, driving up multiples to stratospheric levels. And now it seems like it's happening again. Wondering, what your thoughts on potential comparisons with the dot-com boom and then the dot-com bust after it, particularly with regard to, ridiculous valuation, extreme sentiment in some sectors in your area.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street.
Go to hedgeye.com/research to subscribe.
Enjoy the rest of this episode.
Yeah, it's a good question. I think that if this is, if we are 1999 right now and entering like an AI boom, I would say multiples ain't seen nothing yet. Like from May of 99 to like 1 year later, the NASDAQ went up like, I don't know, something like 75%. And I promise earnings did not go up 75%. So, so I would say that there are things that remind me of the two events. Like, for example, like if I'm looking at a company like Salesforce, for example, who has, like, I would say one new product called the Data Lake. And their data lake offering, I guess I'm not an expert yet, but it seems to be, I'm going to be overly crude here and just basically say that it's taking customers' data and reselling it back to them, even though that's kind of already their business model because it's a large database or it's like kind of like Excel that is customizable hanging in the cloud that you can access that can be shared with your teammates. So it's kind of like a very crude, basic app at its core, at least the Sales Cloud is. And so offering a data lake on the side, I don't know if that's going to be successful. And my point is that in the last decade, more and more of what Salesforce has been able to sell has been from acquisitions, right? They acquire something and the sales force is trained quickly on what are the key things that clients need from that newly acquired asset. And they go around to every account and they offer those key crucial things for free. The accounts sort of standardize on it, get used to it. It's part of the Salesforce package. And then within 2 years, they're paying for it through the nose. And so it's also why, by the way, Salesforce can never like sell down its pieces, its assets, because it's every good part of every acquisition is written into every license agreement at every major company customer. So it's not anyway. But the point about this is where I'm going with this. Sorry, is that you're looking at that and you're trying to figure out like, should I go long Salesforce or short Salesforce? And you see the basics. You see that they are turning humans into a buyback, meaning they're cutting headcount and increasing buyback. So, I mean, that's a horrible way to say it, but it's just true. So maybe that's a catalyst on the positive side. I mean, I want to barf, but yes. And then you want to think about the growth side, and they're investing in AI in order to renovate and refurbish and refresh their products. And the question is, like, as a bear like me, you'd have to really think. I mean, I'm not officially a bear. We haven't like published, a rating on Salesforce, just to be clear. But I think I've spoken on the morning call about them before, and I'm not like the most positive person on it. But to be clear, like they've taken away all acquisitions from this thing, and this data lake thing, is flip a coin. I don't think so. I don't think it's going to be amazing, but I probably have more work to do there. But you have to, as a potential bear, you have to wonder, like, could AI actually lead to like a big product upsell there? Like, could that add $1 billion of organic revenue growth in the coming quarters? Like, is there really something there that clients are going to pay for? And you can't just automatically say, no, my gut says no, but like, you have to do the work. And so it's like that moment where companies adding internet, in the late 90s were considered like adding it's a book company, it's a bookstore company, and they just added a .com. How much does that change the valuation? It did, because people were like, wow, they have this whole new channel that they can sell into. And the channel has everything we know about it, right? Everything we know about the internet having high incremental margins. And so there was this like rush of companies sort of building out. And I remember a Fidelity portfolio manager. I didn't work at Fidelity back then. I did later on, but I heard the lore when I worked at Fidelity. They were portfolio managers walking around being like, I like to sprinkle internet into my, or technology or .com into my portfolio. Meaning that's kind of like saying like, I have no freaking clue. I'm going to throw some darts though, because I'm going to have some high multiple nosebleed stocks that are going to go up every day for no freaking reason other than they went up yesterday, and momentum loves momentum. And that's kind of it's not, we don't really have that today with AI, right? Because not every declarative AI stock is going up on AI. I think Palantir is going up because it was heavily shorted. I think C3 is going up because at the bottom it was like 80% net cash to cap. So and heavily shorted. And so like, a second or even third derivative inflection there where results stop getting worse potentially, which I haven't even looked at results, but I'm assuming that's what happened. And that causes a big short squeeze, even though it's not like succeeding in AI necessarily. So I don't think that we are in this like massive AI hype cycle. I think we could become in one, but I don't think we are in one. I think companies are all, so in terms of equities, I don't think we're there yet. I think companies are chasing the AI reality and throwing a lot of money at this. And I don't know where that goes. Like, does that lead, like, are we going to start seeing like companies like Salesforce, for example, having success in AI? And then suddenly like the equity is going to go kaboom upward, and that's just going to, now every investor is going to be looking for AI in every single company. I know that the AI supply chain is something that investors are looking at, right? NVIDIA, and then what comes next is DRAM, and then what comes next is whatever, power management, and then there's like all the way down to data centers. And Rob Simone talked about this, that he and I had this conversation with a client recently about data centers and the AI, or the implied NVIDIA impact to data centers is quite large. It's meaningful in terms of the incremental capacity that has to be built out just to support existing NVIDIA orders. But that's not the same as like an AI boom where you're like, oh my God, Salesforce announced an AI or has an AI product, and therefore they're going to add billions of dollars of revenue in the short term. And so I don't think we're there yet in equities. We seem to be there a little bit, or we're going there with actual fundamentals, with companies actually spending big dollars without a clear ROI in sight, without clear understanding. And it's funny because a minute ago, those same companies were like firing people, cutting budget, pushing out. I mentioned, those of you listening, you're going to be getting this as usual on a Saturday morning, but I mentioned this today's Wednesday. I mentioned this on the morning call this morning about HashiCorp, that HashiCorp is the way of the future. It is a monolith in its category, basically, for this approach of managing your infrastructure via multi-cloud. The largest companies in the world are going in this direction. However, many of them have agreed to this architecture, designed this architecture for Hashi, but haven't really pulled the trigger on closing deals because we're in this macro environment, which is like anybody's guess of like what's going to happen next. And so people have frozen spending. And so we've been in this climate where people have been pushing out spending, freezing spending, doing whatever you can to like lower the budget. And then suddenly Hashi's needed now again, because if you're an AWS shop or a Google shop or a partially on-prem shop, and you suddenly have an Azure AI account open, and you need all of your assets to integrate with that Azure AI and get your data there and start working with their LLMs and whatnot, and have kind of like this open API layer of GPT-4 in the layer in between some of your apps, you need to manage your infrastructure across multiple clouds, and you need to do it right, and you do it ASAP and fast. And so suddenly there's a reason to come back to Hashi and be like, boom, okay, we're done waiting. Let's get this deal done. And so I don't think that's happening like a run of the bulls, but like we're not in Spain in the middle of the summer, but I do think that's starting to happen a little bit. There's a trickle, there's a green shoot there, which potentially drives a little bit faster growth for Hashi on the forward basis than what what everyone's factoring into estimates today. So that's a good thing. And my point is the AI supply chain is getting a lot of love from investors, but not the AI like product love, not like I said about the Salesforce having an AI product or ServiceNow potentially having an AI product. Those things are still being met with skepticism at the investor level, even though the companies themselves are investing like crazy. And for example, even just take the Accenture investment, right? The famous Accenture investment, they put up $3 billion for AI. First of all, it's fantastic marketing on their side, right? Because is anyone really going to know if they've spent like only 1/10% of that $3 billion? No one's going to know. Their customers aren't going to know. And they're sending a message to all their customers, which says, hey, there's this big new thing. You're all trying to figure out what to do with it. We're going to figure out how to do AI for you. So just come, you can go, don't worry about it. If you guys can't figure out AI, just come to us and we'll have figured it out for you. And that's another reason to work with Accenture. It's brilliant marketing. Every major new tech thing that has happened is always good for IT services. By the way, in the beginning, they always say like, oh, this is going to kill IT services. I don't need IT services anymore. I just go to GPT-4. Or I don't need IT services anymore. I just push everything to cloud. I'm going to have applications running everything. I don't need IT services. I mean, but did cloud actually kill IT services? No, it actually, I know someone who made his retirement money selling an IT services company that was built early on for cloud. And it was called, cloud, whatever. I don't even want to say, because I don't want to give the person's identity away, but he sold that company to a larger IT services company who was late for cloud and saw that this business was already strong and up and had many consultants and was trained and had lots of customers and momentum and growth. And they were bought for a big number. He, retired off of that. I guess we should start some AI consulting thing right now. Probably many consultancies have already kicked off for that. But anyway, long-winded answer. But to compare today in internet 1999 to AI, I would say the difference so far is companies are spending a lot to chase AI, just like companies spent a lot to chase the internet back then, and algorithm. But while investors are looking at the equity supply chain for opportunities downstream from NVIDIA, they're not chasing every little AI product boost that in theory is going to, all the ships that will berth into the sea, and potentially, maybe they'll trigger more enterprise demand and maybe not. So long-winded answer, but that's kind of like a complicated where we are now with AI, I think.
That's fantastic. Phenomenal color there, Ami. I'm actually looking into some AI companies as well and trying to figure out the winners and losers, particularly the smaller guys. I completely agree with you. It is more about, can companies monetize this sort of once in a lifetime event with, GPT products and so forth. And lots of companies, not only companies in China, but particularly companies in China, they're also thinking about pursuing their own AI products and projects. And it's funny, Ami, we talk about the incredibly high multiples right now in US tech, and then maybe just valuation doesn't matter anymore. I look at my space in China, and there are probably only a few potatoes that are overcooked on valuation. Most of my names are trading at historic lows on valuation, but I've argued many, many times that valuation just does not matter, or it's not the main catalyst, particularly for China. But it's interesting nonetheless to know what an incredible dichotomy that's going on in valuation, US tech versus China tech.
In what way? You mean like US tech is overvalued and China tech is undervalued? Is that?
Well, I don't want to say overvalued, but the numbers are much, much higher, no matter what metric you use. Okay. Than what China is, implicit in some of the China names I cover, particularly in the tech and internet space. It's just no comparison at the moment. And part of the reason why you've seen, a huge rally in NASDAQ, and China had a big rally to begin the year, but since then it's been more wobbly, is kind of how I would describe it.
Yeah, I mean, from a valuation perspective, just looking, the dream scenario is you're back in 2012. Not that anybody in 2012 knew that we were in 2012 at the time, but in 2012, valuations were just ridiculously cheap on EPS, on free cash flow metrics, and you were at the very beginning of a long and rising cyclical tailwind. So everyone wants that. That's like the dream, right? You want to get there. If you're really starting a new long-term cycle, you want to start it with, valuations that reflect lowered estimates. And I admit that with the bounce that we've seen so far, estimates have actually come down, stocks have gone up. And which means that stocks are already anticipating a rebound of estimates to some degree.
Yeah.
And you kind of have to figure out, is there more to go for estimates going higher? That's actually the question we're figuring out right now. We're going to have our themes deck on Monday. Highly recommend. It's the kind of thing that we actually really like. We've been able to bring it down to a couple of key slides that just express it all in terms of where we are in revenue growth as terms versus valuation for the whole sector. And we're adding billings and RPO billings this time for this exact same thing. So you'll be able to just look at it and kind of just eyeballing it and say, oh, that's bullish, or you could say that's bearish, right? You can actually just in a single visual make a kind of like a determination about the sector, like long or short. And then within that, you obviously always want to be layering in your good company, bad company stuff, your positives and your negatives, your alpha. But it's good to know, it's good to have like a really good orientation. That's Monday, July 10. So for those getting this on a Saturday morning, Tech Pro subscribers have access and institutional subscribers have access. If you need access, just find a way through hedgeye.com or ping sales at hedgeye.com or ping tech at hedgeye.com, and we'll try to help you out. But that's what we're trying to figure out right now. And what I would say about valuations is that let's talk about just plain vanilla software company. Like, let's just take like Joe Stupid software company. Okay. Old rule of thumb was you can get a software company up to that 40 to 50% free cash flow yield, free cash flow margin, I would say. And that's because your maintenance margins are so freaking high. That, because they used to sell you your software. Like, so let's say you paid $100 for a license to use the software forever, but then you had to pay like $20 a year for access to the support and the patches and the maintenance and, whatever you needed. And the cost structure for the companies on cost of goods sold for that support or maintenance, $20 was like 1%, like really literally, it was like 99% margin, gross margin. So you can get those old school companies, you can get them up to that 40+% range of free cash flow. The cloud companies, it's to be TBD, because the cloud companies, you're actually hosting the usage of your clients, and that costs money. So it depends how elegantly your software is written. If your software is written really in like light and creatively and cheap, it means that it's going to use less CPU, less memory, less storage on the underlying cloud. And so you could have higher margins. If it's old and it's written poorly, you're going to have lower cloud margins there. So call it like something like, it could be like 65 to 85% gross margins, depending on, kind of like ahead of the pack, behind the pack in that zone. So your free cash flow margins are going to be lower. They're going to be more like that 25 to 45% range, I guess 45, but maybe at the max. But if you look at valuation and you say, okay, well, take a company trading at 5 times sales, right? So, and if you can get that company to call it, I said 25, to call it 35% free cash flow margins, then that company is trading at 14 times free cash flow. That's below market, right? So 5 times free cash flow, that's below market. And that's assuming like a market, like that's below market in software, which is over 20. And that's also like, but just below S&P. And that's assuming S&P level growth. So let's say, I don't know, 2-3 times GDP. And so anytime you have software companies trading at 5 times, you kind of have to take it seriously, because you're like, well, this thing has 25, 30, 40% growth ahead. I mean, for 5 times revenue, Jesus, like, you're going to make money hand over fist with that entry point. So today, if I look at like for 20% revenue growth on a forward basis is going to cost you something like 8 times sales today for 20% growth. So it's not like super cheap. It's not like saying 5 times, which it was, or 5.5 times, like kind of at the bottom, 8 times a little pricier, but it's still not like ridiculously priced. You can still get a decent ROI on that, because that's 23 times free cash flow. And again, you're growing 20% year over year. So that's just 1 year forward, 22, 23 times. If you're growing that top line nicely, and the free cash flow line aside it, you're, obviously within a couple of years, that number falls to, hang on, I'll give you the math here.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
That math of valuation falls to 15, 16 times forward free cash flow, 2 years out. So you get your ROI pretty fast from a grower. And so I guess what I would say is that software today is not quite as cheap as it was in November, which worries me, especially with estimates down. But it's also it's not punching people in the nose, causing bleeding for the valuation. Obviously, you have to take that, like company by company, because not everything is right. A line lines up, alongside a single line. But so that's kind of like how I would think about valuation today. It's up, but it's not offensive.
Okay. Yeah. I mean, on the topic of cloud, at least in my world, the one entity that always gets a lot of attention is Alley Cloud. It's interesting. You're giving scenarios on me of, if a XYZ grows certain percent, could be a reasonable EV over sales or, free cash flow multiple on that kind of business. Well, what if you have an entity that doesn't grow anymore? Right. And then the analysts out there are thinking, wow, Alley Cloud, it should be like AWS equivalent. We should put a huge multiple on the EV to sales. No, you can't do that anymore because you have different growth profiles. So that's kind of my argument against Alibaba, particularly with the Alley Cloud valuation component of it. It's interesting because, other people are definitely putting, 5, 8, 10, even double digit multiples for this business where they've clearly shown enormous deceleration. So what I will argue on that perspective is the market got it right, or is getting it right. And there's a reason why, Alibaba is trading where it is. I just wanted to mention that one example because, as you talk about cloud, everybody always gets excited about putting pretty steep sales multiple as long as the growth is there.
Remember like the Ali Cloud is infrastructure as a service. So it's not just about the free cash. Like there, I would say it's not just about operating margin, let's say. You have a serious amount of CapEx required to provide the scale of service that is required to be a top tier cloud provider and to win workloads over time and keep them. So your margin considerations are different. And then I would also say that on although those businesses, if you can create a cloud and infrastructure as service layer and win real clients on top who are using sticky long-term services on top of your base layer, that's today, I would say it's bedrock technology. Like it's a good place to be, good long-term position, and still not done with the penetration curve. If it's a loser, if it doesn't have if they're not winning customers, if they're not winning new business, then it's a tough place to be, because to catch up, you still have to spend the CapEx. You can't, if you're not growing, you're either shutting down that business, or you got to go spend the CapEx on top of the fact that you're not growing in order to get back ahead of it. So it's a tough place. And what I would say about the no growth side in SaaS, not in infrastructure as a service, because the CapEx front that I mentioned, but in SaaS, even those companies that stop growing, they become really interesting to the private equity group, because as you can imagine, if the company has a clean balance sheet and is generating 30 to 40% or something, or is on their way towards generating, 40% free cash flow margins, you can lever up 40% free cash flow margins and spend that on the leverage you spend on acquisitions, and that fuels some of the growth and such. And so, you get your multiple, as long as you keep your margins, you get your multiple return there for private equity guys. It's more like financial engineering rather than like real company building. But again, the cash flow perspectives in software attract a lot of vultures and bottom feeders and such, because it's attractive.
Yeah, I mean, I think Ali Cloud actually does a little bit more than IaaS. But I mean, I agree with you. It is a different type of margin profile than your sector. But my point on Ali Cloud is just like there's competition internationally, then there's much more competition domestically, and that involves a lot of the state-owned entities. But we'll see. I mean, I'm still looking for something that if you look at what I like in my space, I love growth. I really love growth, and it's hard to find those companies right now in a difficult sort of choppy, wobbly environment in China. But there's still great companies out there that can deliver outperformance on the growth side, and I think investors should give them more than a benefit of the doubt there in terms of trying to control losses as well as grow, which is a very difficult combination, as you know. But this has been an interesting discussion. I mean, those are the questions I had on my side, and I'll just turn it back over to you.
Yeah, I mean, we're getting towards the end of the time, but I did want to ask you, I know that you're heading to China next week. Safe travels, by the way. I hope you have a healthy, safe, happy trip.
Thank you.
Good success work-wise. May fortune favors the Felix. But I guess my question is, like, I noticed that recently the United States issued a travel warning for going to mainland China, and it's recent. And it was after China jailed a 78-year-old man claiming he was a spy and gave him a life sentence, which I have no idea whether he's a spy or not. I think I could make fun of it and be like, we could make a movie called James Geriatric instead of James Bond. But I guess, like, tell me, like, how you're thinking about that. I know you're a U.S. citizen. I mean, I don't know. It strikes me as odd because there's aren't there like thousands of U.S. citizens living in China right now, and like tons of major U.S. businesses who have people going back and forth between the U.S. and China every day? Like, is this like a Brittany Griner situation in moment where, for example, I'm referring to the WNBA, a basketball player who was arrested in China early days of the Ukraine war and jailed as bait for just ransom, essentially, that Russia wanted to make a prisoner swap, and she was just randomly taken for no really good reason. I mean, there was some element there, but nothing nothing that you would throw somebody in jail for a lengthy period with no trial and such. Tell me how you're thinking about this trip. Not that I want to cause you to be nervous about it, but like, tell me how you're thinking about this kind of like this situation.
Yeah, I really don't have a comment on the travel advisory that's been given out. I think there's always situations, right? International situations where it could lead one country to issue an advisory, but more from a political perspective than anything else. I mean, I'm going there to see clients. I'm going there to see management teams and some of my merchant sources that I've been in communication with. I haven't seen them face to face in over 4 years. So I'm going over there to go see people I think could give me some context on what's going on a daily basis on the ground in China. So I don't think a travel advisory is gonna get me worried. What I am worried is I still have to take a COVID test going into Beijing. So I'm gonna have to find a center. I'm sure there are plenty of resources there, but just logistics wise, I am a little bit nervous. Going to mainland and then coming out of mainland and coming back to the US from a logistics perspective. But frankly, everything's opened up. Very little, requirements, restrictions on going from country to country. It's completely different picture from maybe a year ago. So from that perspective, I'm more comfortable. But yeah, I'm super excited. And I'll share some highlights of my trip with you guys on next podcast.
Yeah, awesome. That would be great. And the insights can be, just all the way down to like anecdotal observances of, of consumer patterns, consumer buying, things like that, distributor mentality, whatever kind of like, especially if you see stuff from the PC supply chain or anything like that, or from the cell phone supply chain or data center supply chain, and discuss if you hear about views of like the internal buildup of semiconductors and the national objectives there. All of that, greatly appreciated insights. And with that, I think we'll wrap today. It's been an interesting one to catch up with Felix. I think we covered good ground with AI. We covered good ground with China, and we will follow up and see you on the next podcast. This has been season 3, episode 13 of Unscripted Equity Curiosity. Thank you.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.